The economic entity assumption deals with the assumption that the companies are going to report all its assets, liabilities, and equity and the results of their operations or its operations, and only those pertaining to that company. So when you think about corporations, they're owned by shareholders. Well, even though it may seem like they're one and the same, you have to keep the owners separate from the corporation. Because remember again from before, corporations are separate legal entities. So what that means is that owners are not allowed to use company resources for their own benefit or their own personal affairs. And on the other hand, too, owners are not, their personal assets are to be kept separate from the company. So you don't want to commingle. In addition, companies have to consolidate subsidiaries. And that means that if a parent company has financial control over subsidiaries or other companies, it has to report it as if it was one company. And the idea behind that then is that you don't want to have it where a company, say, does transactions with itself and not report it as one entity. Enron, in a sense, did that. It had set up a bunch of what they call special purpose entities, and they ended up doing business with themselves, inflating the financials of Enron, the parent company, where if they had consolidated, those types of transactions would have canceled out because you can't really do business with yourself. So it's important to consolidate. And the thing is, though, is you often own less than 100% of a subsidiary. So what you do is you report 100% of the assets and the liabilities, but on the income statement you are going to reflect how much is not owned by that company. So again, you report it all as one.